Hey everyone, welcome back to Corporate Decoder, the place where we uncover why companies suddenly decide to drop a ton of debt like it is hot or not. Today we're looking at Albertsons Companies Incorporated and their recent move to issue a massive amount of new debt. Now this might sound a bit dry, but stick with me because this could tell us a lot about where the grocery giant is heading and what it means for you as a shopper or even an investor. So Albertsons Incorporated is a big name in the grocery world. You know them from stores like Safeway and Vons. They had a big announcement on the 10th of November 2025. They decided to issue two new sets of senior notes. These are basically loans that the company promises to pay back with interest. The first set is for $700 million with an interest rate of 5.5%, and they are due in 2031. That means the company will pay back this loan by March of 2031. Then they have another $800 million in notes that are due in 2034 with a slightly higher interest rate of 5.75%. These will be paid back by March of 2034. Now, why are they doing this? Well, it looks like a big part of this is to pay off older, more expensive debt. They plan to use this new money to pay off all $750 million of their 3.250% senior notes that were due in 2026. Think of it like swapping out a high interest credit card debt for a loan with a lower interest rate, but for a much larger amount. They also plan to use some of this money to pay down money they owe on their revolving credit line. This is like a flexible loan that companies use for day-to-day needs, so they are essentially trying to clean up their overall debt picture. And of course, like any big financial move, there are fees and expenses involved in making all this happen. All these details about the loans, the interest rates, and when they need to be paid back are written down in a formal contract called an indenture. This is basically the rule book for these loans, and it sets out who is responsible for what. Wilmington Trust National Association is acting as the trustee overseeing this agreement. The interest payments on these new loans are going to be made twice a year, so on May 15th, and the 15th of November every year starting in May of 2026. And this will continue right up until the loans are fully paid off. Now, an important detail here is that these loans are what we call senior unsecured notes. This means they are not backed by any specific company assets, like a mortgage is backed by a house. If Albertsons has trouble paying these back, the lenders have a claim on the company's assets. But there isn't a direct pledged asset like a building or equipment. The good news is that all of Albertsons' other domestic subsidiaries are essentially backing these loans. This means if the main company has a problem, these other parts of the business are also on the hook. Just to be super clear again, these notes are not secured by anything specific, so if things went really south for Albertsons and they couldn't pay the lenders, wouldn't automatically get a specific store or warehouse. They would have to go through a more complex process to try and get their money back from the company as a whole. Here is a part that can be a bit tricky, but it is important Albertsons has the option to pay back these loans early before their due dates. But if they do this before a certain date, which is the 15th of November 2027, for the 2031 notes and the 15th of November 2028 for the 2034 notes, they basically have to pay a penalty. This penalty is called a make. Double hold premium. It ensures the lenders still get a certain amount of return even if the loan is paid back early. It is like paying an early termination fee on a contract. The good news for Albertsons is that after those specific dates, they can start redeeming the loans without that hefty make. Double penalty if they pay back the 2031 notes after the 15th of November 2027, but before the 15th of November 2028, they would pay back a bit more than the original amount, then a smaller amount more until they can pay it back at its face value. The par value after November 2029, essentially the penalty for early repayment, gets smaller the longer they wait. The same logic applies to the 2034 notes, but with their own set of dates and percentages, they can redeem them with a smaller penalty after the 15th of November 2028. And then at face value after November 2030, it is a way for the company to have flexibility to refinance if interest rates drop significantly. A key point is that these new loans do not require any sort of mandatory redemption or sinking fund payments. This means Albertsons doesn't have to set aside specific amounts of money regularly to pay down the principal before the final due date. They only have to make the regular interest payments and then pay back the full principal amount at the end of the loan term, unless they choose to redeem it early. This next part is a really interesting protection for the lenders called a repurchase upon a change of control. This means if something major happens, like if Albertsons' assets are sold off to someone else, or if a new owner takes control of more than half of the company's voting power, and this causes the credit rating agencies to lower the rating of these notes, then Albertsons has to offer to buy back all these low As early the offer price is 101% of the amount owed plus any interest that hasn't been paid yet. This is a way to protect the investors from being stuck with loans from a company that has undergone a drastic change. The indenture also includes a bunch of rules or covenants that Albertsons and its subsidiaries have to follow. These are pretty standard for these types of loans. They include restrictions on things like putting liens on their assets, which means pledging company property as collateral for other loans, and also limitations on merging with or being bought by other companies. These are designed to keep the company financial health stable so they can continue to pay back their debts. And of course, there are defined events of default, which are basically triggers that would mean the loan agreements have been broken. These include not paying back the principal or interest on time, failing to follow the rules we just talked about, defaulting on other significant debts if there are major lawsuits against the company, or if the company faces bankruptcy. These are all serious situations that would have big consequences. So to wrap up, this filing is essentially about Albertsons taking on a lot of new debt to pay off older debt and free up some cash. It shows they are actively managing their financial structure and trying to get better interest rates on their borrowings. Looking at this broadly, Albertsons is making a pretty significant financial maneuver by issuing these new notes. It signals a move to refinance their debt, which generally is a positive step if the new rates are lower than the old ones. And in this case, they are swapping out 3.250% notes for new ones at 5.5. 0% and 5.750%. This means they are borrowing more money at a higher interest rate, which might seem counterintuitive, but remember they are retiring older debt that was maturing soon. Anyway, the increase in debt isn't necessarily a red flag on its own, especially if it is part of a strategic refinancing. However, the sheer amount is substantial. The company is taking on more long-term obligations. These loans are unsecured, which means if the company runs into real trouble, lenders don't have specific company assets to seize easily. This puts a bit more reliance on the overall financial health and cash flow of Albertsons. The change of control clause is definitely something to watch for. If a new owner or major reshuffling happens, it could trigger a buyback of these notes, which would put a significant financial strain on the company at that particular moment. It highlights a degree of risk that the lenders are trying to mitigate. The covenants are typical, but keeping an eye on whether Albertsons adheres to them is crucial. Any breach could signal underlying financial stress or strategic shifts that might not be immediately obvious. Overall, Albertsons appears to be proactively managing its debt load, aiming for potentially better terms and more financial flexibility. But the increased borrowing and higher interest rates on the new debt mean they are carrying a heavier debt burden going forward. The success of this strategy will depend on the company's ability to generate strong and, consistent cash flow to service these new obligations, and whether the overall market conditions remain favorable for grocery retailers. Alright, that is our breakdown of Albertsons Companies Incorporated's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.